Averages coming off 2 winning days as investors look beyond the shadow of trade tensions and digest a mountain of corporate results. As we close out this busiest week of earnings, what are they telling us about the state of the current bull market? Joining us today, Fidelity's Director of Global Macro, Jurrien is with us. Jurrien, great to see you again. Good morning.
Good morning.
The bulls would argue, look, bond market is relatively well behaved, and we have passed several tests, whether that's about would-be tariff skirmishes or deep-seek. What do you think?
Yeah, so we know what the known unknowns are, of course: tariffs, immigration policy, the Fed, bond yields, et cetera. But I think overall the market's in a good place, right? So we're 5 quarters into an earnings cycle. We're 9 quarters into a bull market cycle. This one is about 28 months old. The median is 30 months, good for a 90% gain. We're at 28, good for a 78% gain. That doesn't mean it's going to stop in 2 months. It just, there are many cycles that go well beyond the median, of course. But earnings are good. We're in the fourth quarter earnings season. It's kind of par for the course. 78% beating by 700 basis points, double-digit year-over-year growth rate, and so the earnings cycle looks quite robust. The Fed, I think, is done cutting rates, but that's okay. The market or the economy are not hanging on by a thread, waiting for more rate cuts. But it does, create an issue on the long end of the yield curve. If we continue to get that bearish steepener, when yields get to 4.5, 5, it doesn't mean the bull market's going to end for stocks, but the bull market has to pay attention because at that point, what we consider the risk-free rate starts to compete with equities, and equities have to price accordingly. So I do think that is one of the known unknowns for this year that will continue to kind of haunt the market from time to time, but as you point out, it's quiet right now. But for the most part, it's earnings, it's interest rates, it's the Fed, and then, of course, we have to figure out, what happens on tariffs and immigration, and, of course, nobody really has the answer on that.
Right. On jobs, and we'll get more numbers tomorrow, people are starting to build arguments like job openings for government jobs are down year on year. Construction job openings are near the lowest since 2017. The hiring rates, the lowest since 2013. Do you sense vulnerability there?
I think for now, the cycle is in a good place. I mean, it is a maturing economic cycle. It's a maturing bull market. But the labor market, which was very unbalanced during COVID and following COVID, because the economy obviously shut down and then reopened fairly quickly, and the labor wasn't there to help reopen. And so that's why we got into those very tight labor market stats. That's all been resolved. And of course, we don't know what immigration policy is going to do to those numbers, but we're still in a place where people are employed. They're making a good wage on average. They're keeping up with inflation at this point. There's not a lot of household debt. That bubble peaked in 2008 during the financial crisis. So the overall fundamentals are good, but it is a relatively slowing economy, and that's okay too. You can't fire on too many cylinders, or you get the risk that inflation genie, which may or may not have been put back in the bottle a couple of years ago, comes back out.
How about these comments from the new Treasury Secretary, Scott Bessent, saying we're focusing on the 10-year, less than the Fed interest rates, and implying that there's work to do there when it comes to lowering inflation and also tightening fiscal policy? I mean, how serious do you think that is in terms of when you make the forecast on rates and on the stock market?
I think the risk of a bearish steepener, so long yields rising towards 5 and maybe even above 5, is clearly a risk for the stock market. It doesn't have to end the bull market, but whenever the risk-free rate, and we can argue whether treasuries are the risk-free rate or not, but whenever that risk-free rate starts to compete with the yield that investors get on equities, the equity market has to respond by becoming more competitive. Otherwise, investors wouldn't be getting compensated for that extra volatility that they get from investing in the stock market. So that is clearly a risk as we get later on the cycle, that the rise in the yield takes away kind of the mojo of the market in terms of how much PEs can amplify growth in the on the earnings side, right? So that's what happened in 2024 and 23. You had a very large multiple expansion that gave us those 20+% returns. I think that's hard to see happening again in 2025. So we have to rely on earnings. But if rates rise, obviously that's going to depend on the supply demand of treasuries, how many treasuries are being issued, what maturities, et cetera, how much deficit can be cut. And so these are all open questions. But I would say, back to kind of where we were in the 80s or 60s, rising rates do eventually compete with the risky asset. And so that risky asset then has to remain at a competitive price. And so I do think that is one of the main dynamics going forward here.
Yeah, we'll be keeping our eye on where exactly that threshold for pain is in the weeks to come, as well as the whole tax debate, which we're going to unpack that box fairly soon. Jurrien, talk soon. Thanks a lot. Jurrien Timmer.
Thank you.